Investing is a journey towards financial well-being. It requires careful planning and informed decisions. Index funds are a reliable way to grow wealth over time. They mirror the performance of market benchmarks like the S&P 500 or NASDAQ 100. Think of a basket of stocks representing a market segment. Index funds hold these stocks in the same proportions. This passive approach aims to match the index's returns. Simplicity and transparency make index funds popular. They offer a straightforward way to invest in the stock market. Index funds provide diversification, spreading risk across assets. Whether saving for retirement, a house, or education, index funds are valuable. Understanding index funds is crucial for your investment journey. We will explore the mechanics, advantages, and selection criteria of index funds. Index funds operate on a simple yet powerful principle, tracking a specific market index. An index such as the S&P 500 is a collection of securities like stocks or bonds selected based on predetermined criteria. These criteria might include market capitalization, industry sector, or investment style. When you invest in an index fund, you are essentially buying a tiny piece of all the securities included in the underlying index. For example, if you invest in an S&P 500 index fund, you own a fractional share of all 500 companies listed in the S&P 500 index. This ownership structure allows investors to participate in the collective performance of the chosen market segment. The beauty of index funds lies in their passive management approach. Unlike actively managed funds where portfolio managers constantly buy and sell securities to outperform the market, index funds aim to replicate the index's returns as closely as possible. This passive strategy minimizes trading activity, resulting in lower transaction costs and management fees for investors. By mirroring the index's composition, index funds provide investors with broad market exposure and diversification, which we will explore further in the next section. The simplicity and efficiency of index funds make them a compelling choice for investors seeking long-term growth without the intricacies of active stock picking. In the world of investing, diversification is often referred to as the only free lunch. Diversification involves spreading your investments across different asset classes, sectors, and geographies to reduce risk. Index funds are inherently designed to provide diversification, making them a valuable tool for investors seeking to mitigate potential losses. When you invest in an index fund, you are not putting all your eggs in one basket. Instead, your investment is distributed across a wide range of securities represented by the underlying index. For example, an S&P 500 index fund offers exposure to 500 large-cap U.S. companies spanning various industries. This broad market exposure helps to cushion your portfolio against the impact of poor performance from any single stock or sector. If one company in the index faces headwinds, its impact on your overall portfolio is minimized by the gains from other companies in the index. This diversification acts as a shock absorber, reducing volatility and potentially enhancing long-term returns. By investing in index funds, you can achieve diversification effortlessly without having to research and select individual stocks. This built-in diversification is a significant advantage for investors, especially those new to the market or lacking the time and expertise for active portfolio management. Section 4. The advantage of low fees. One of the most compelling reasons to consider index funds is their low-cost structure. Index funds typically have lower expense ratios compared to actively managed funds, which can significantly impact your investment returns over time. The expense ratio represents the annual fee charged by the fund manager to cover operating expenses, such as administrative costs, trading fees, and management fees. Actively managed funds often have higher expense ratios because they require more human intervention and research to select and manage individual securities. In contrast, index funds follow a passive management approach, simply tracking the underlying index, resulting in lower operating costs. Lower expense ratios mean more of your money stays invested and working for you. Over the long term, even a small difference in expense ratios can have a substantial impact on your overall investment returns. The power of compounding ensures that every dollar saved on fees can potentially generate more returns over time. When choosing index funds, it's crucial to compare expense ratios among different providers. Look for funds with low expense ratios, ideally 0.1% or lower, to maximize your investment potential. The savings you achieve through lower fees can significantly contribute to building your wealth over the long run. Section 5. Navigating the world of indices. The world of indices offers a range of investment options to suit different risk tolerances and financial goals. Understanding indices is crucial for selecting index funds that align with your strategy. Stock market indices track specific markets or segments. For instance, the S&P 500 includes large-cap U.S. companies, while the Nasdaq 100 focuses on technology-heavy companies. Bond indices track fixed-income securities like government or corporate bonds. They offer exposure to the debt market and are often less volatile. International indices track markets in specific countries or regions. They provide diversification by investing in global companies. Sector indices focus on specific industries like technology or healthcare. These indices allow targeting investments in promising sectors. Research the underlying index to ensure it aligns with your objectives. Consider market capitalization, geographic focus, and sector exposure. By understanding indices, you can select funds that match your goals. Section 6. Selecting the right index fund. Choose the right index funds for your portfolio by considering these key factors. Expense ratio. Look for funds with low expense ratios to minimize costs. Compare expense ratios among different providers. Tracking error. Lower tracking error means better alignment with the index fund provider. Choose reputable providers with a proven track record. Consider your investment goals and risk tolerance. Diversify your holdings to reduce risk and enhance returns. Consult a financial advisor for personalized guidance. Section 7. Conclusion. Index funds. Pillars of long-term investing. Index funds have revolutionized the investment landscape by offering a simple, cost-effective, and diversified way to participate in the growth of the financial markets. Their passive management approach, low fees, and broad market exposure make them ideal for investors seeking to build wealth over the long term. By investing in index funds, you are essentially harnessing the collective wisdom of the market, benefiting from the performance of a diversified basket of securities. Their transparency and predictability make them suitable for investors of all levels of experience, from beginners to seasoned professionals. Index funds are not about trying to beat the market. They are about joining it. By embracing a long-term perspective, riding market fluctuations, and taking advantage of compounding returns, index fund investors position themselves for financial success. As you embark on your investment journey, consider making index funds the cornerstones of your portfolio. Their simplicity, efficiency, and potential for long-term growth make them invaluable tools for achieving your financial aspirations. Remember to diversify your holdings, choose reputable fund providers, and stay informed about your investments. With patience, discipline, and the power of index funds, you can navigate the complexities of the financial markets and work towards a financially secure future.